made in a plan to achieve full economic inclusion for every American. I now recognize myself 4 minutes to give an opening statement. Almost 4 years ago, Chairwoman Maxine Waters made history by establishing the first ever subcommittee on diversity and inclusion. Under the leadership of my friend and colleague Joyce Beatty, this subcommittee has closely examined the state of diversity and inclusion in the financial services industry and brought to light the significant disparities that exist in the sector. Without objection, I ask unanimous consent to enter into the record Chair Beatty's opening statement for today's hearing. So ordered. Decades of systematic racial and gender inequalities have compounded to create a system that favors some and leaves many behind. We demand better. One of the greatest accomplishments of this subcommittee was the investigation of diversity and inclusion of America's largest banks, investment firms, and insurance companies. Committee staff received data from an impressive number of top financial institutions and published 3 historic reports revealing a lack of workforce and supplier diversity across the industry. We also uncovered the stark inequity prevalent in asset management. Of the $82 trillion in assets under management, only 1.4% are managed by minority-owned or women-owned firms. These firms are unfairly subjected to bias and assumptions of weak performance, despite the statistical fact that diverse asset managers perform just as well, if not better, than non-diverse managers. We also took a closer look at minority and women-owned businesses and found clear barriers to market entry, limited access to capital, and persistent discrimination. To assist these firms, we've passed several provisions over the last 2 Congresses, including a $60 billion set-aside in the Paycheck Protection Program, codification and expansion of the Minority Business Development Agency, and $12 billion in support of SDFIs and MDIs. I am deeply proud of what we have achieved in this subcommittee and the many ways that our work has moved the needle a little bit further toward justice. But our work is not done. There's much more to do. Despite gains achieved as a direct result of the subcommittee's work, economic inequality persists. Women still earn only 83 cents for every dollar earned by a man, and that gap only widens for Black and Latina women. Minorities consistently experience higher rates of unemployment and poverty compared to white people, a disparity that only worsens in the face of the COVID-19 pandemic. Further, those with disabilities, the LGBTQ+ community, and justice-involved individuals continue to face high barriers to full participation in our financial system, cutting off pathways to wealth building and perpetuating systematic inequality. We still have a long way to go to achieve full economic inclusion for every American. This subcommittee has yet to explore several areas of concern, including climate equity, the impact of crypto on people of color, and financial inclusion for veterans, immigrants, and the elderly. I expect my colleagues across the aisle to continue where we have left off. Creating equal opportunity for a seat at the table is not just the right thing to do, it's the smart thing to do. Diversity enhances performance and elevates integrity and ingenuity, leading to greater productivity, higher profits, and economic growth overall. I am thankful to this subcommittee's dedication to these principles, and I look forward to hearing from our witnesses here today. I now recognize the ranking member of the subcommittee, my colleague and friend Ann Wagner from Missouri, for 4 minutes for an opening statement.
I thank you, Madam Chairwoman. I want to thank our witnesses for testifying before this subcommittee today. Over the past 4 years, this subcommittee has held 18 hearings on many important topics, including equal access to financial products and services, workforce and boardroom diversity, the issue of and underbanked communities, the racial and gender wealth gaps, access to capital for women and minority-owned businesses, and the significance of collecting diversity data in a way that considers the unique context of each American's business. Many corporations recognize that a diverse workforce outperforms their less diverse competitors and are proactively addressing diversity and inclusion. I am encouraged by the set of best practices that our industry stakeholders are voluntarily implementing. This Congress, we have learned about methods that increase retention rates and improve the inclusivity of a workplace. Companies are providing financial literacy training, transparency regarding salaries and promotion opportunities. They're mentoring and sponsorship programs, employee resource groups, and unconscious bias training, along with flexible work hours for working mothers and paid leave. While industry stakeholders are making clear efforts to improve and acknowledge the benefits of a diverse workplace, more can absolutely be done. I look forward to reviewing the current state of diversity and inclusion within the financial services industry, the challenges that remain in accessing financial services products, and the direction it is heading. I want to thank Chairwoman Beatty. I know that she's not with us here today. I have had the pleasure of being the ranking member on diversity and inclusion, and working with my friend and colleague from Ohio, Congresswoman Joyce Beatty, for 4 years now. And we wish her all the very, very best. And I wanted to acknowledge that this may be the first, well, maybe the last hearing that we have on D&I of the 117th Congress. I think this is the first one that she's been unable to attend, but I wanted to applaud her efforts and thank her for her friendship and her work in this space. I yield back.
Thank you, and I totally agree with you. We do miss her today, but we know she is recovering well, so thank you so much. And now we recognize the chairwoman of the full committee, the gentlewoman from California, Chairwoman Waters, for 1 minute.
Thank you very much, Ms. Garcia. As we approach the end of the 117th Congress, I'm reflecting on the tremendous work that has been accomplished under Chair Beatty's leadership of this subcommittee. This subcommittee made history simply by its creation, because it was the first of its kind, and it has proceeded to break new ground ever since. For example, I've been proud to release a series of reports with Chair Beatty that provided unprecedented transparency and accountability into the financial services industry's performance regarding diversity and inclusion. So I look forward to reflecting on this progress and exploring the work we need to focus on next Congress to ensure that everyone has a seat at the table. And thank you, Ms. Garcia, and I yield back the balance of my time.
Thank you, Chairwoman. Today we welcome the testimony of our distinguished witnesses. First, we have Leroy Cavazos Reyna, who is Vice President of Government International Affairs of the United States Hispanic Chamber of Commerce. Next, we have Deborah Gorman, who is the President and Chief Executive Officer of the Green Lining Institute. Next, we have Carolyn Johnson, who is the Chief Executive Officer of Diversity, Inc. Next, we have Mark Morial, who is President and Chief Executive Officer of the National Urban League. And of course, Ms. Johnson and Mr. Morial are joining us by video. And finally, we have Daniel Garcia Diaz, who is the Managing Director of Financial Markets and Community Investment in the United States Government Accountability Office. Welcome to all the witnesses. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer that will indicate how much time you have left. I would ask that you be mindful of the timer so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statement will be made part of the record. Mr. Cavazos Reyna, you are now recognized for 5 minutes to give an oral presentation of your testimony. You may proceed.
Thank you, Madam Chair, and thank you to Chairwoman Beatty and Chairwoman Waters. The United States Hispanic Chamber of Commerce is the largest Latino business advocacy organization. We actively work to promote the economic interests of more than 5 million Hispanic-owned businesses across America who combined contribute $800 billion annually to the economic vitality of the United States. We also operate under an umbrella organization and represent more than 260 Hispanic chambers across this country and have relationships with more than 200 global corporations internationally. Over the past 3 years, the USHCC has worked diligently through this committee and its leadership and Congress in a bipartisan manner to ensure that Hispanic voices around the country are heard and that minorities are reflected at the decision-making tables in America. Today, we want to recognize the critical role that this committee's work has played to bring much-needed help and relief to our small and minority-owned businesses during and after the unprecedented global COVID-19 pandemic. This committee's work has been transformational in the economic recovery, inclusion, and business scaling abilities of more than 12 million minority businesses in our country. On April 20th, 2022, the USHCC sent a letter to the U.S. Senate urging legislators to restore funding for the state small business credit initiative that was cut as part of the bipartisan COVID Supplemental Act. In August of 2021, we expressed our public support for the codification of the Minority Business Development Agency at the Department of Commerce. This historic move will impact the generational wealth and growth of minority businesses for decades to come. It also presents a unique opportunity to create equity in federal government contracting and provide the necessary technical assistance for minority entrepreneurs to expand their contributions to our collective economic vibrancy. Throughout 2020 and 2022, we have conducted a series of advocacy requests to Congress concerning the ability and the transformation of the Paycheck Protection Program to ensure the maximization of this program and the vital role that it played in sustaining minority businesses during the pandemic. The USHCC has also advocated for policies that would empower and expand the reach of community development financial institutions and minority development institutions, a critical role in assisting the most underserved communities in our country. CDFIs have at times acted as the principal beacon in financial services that have allowed minorities, women, disabled veterans, and rural entrepreneurs the ability to start or scale their business. The funding that was afforded to CDFIs under the CARES Act graduated them into the next phase of their service evolution. As we enter a new era of congressional representation, we must sustain and we must affirm the importance of funding financial institutions that serve the most vulnerable people who drive the American economy. We have made huge legislative strides to correct the economic injustices of our past and must not sit on the sidelines of American economic history while we still have so much work to do collectively. This work should not be politicized. Rather, this work should be approached in a bipartisan manner to reflect the economic needs of America's more than 33 million small businesses, of which 12 million are considered minority-owned. As we move into this next phase, we urge Congress to take advantage of the current legislation that is being considered. We ask you to consider H.R. 4112, the Clarity in Credit Score Formation Act, which would strengthen the Consumer Financial Protection Bureau. We further affirm that protecting Credit Score Act is important to small businesses and consumer reporting agencies to establish a joint online portal. And the USHCC affirms and sustains the importance of modernizing the Community Reinvestment Act, a critical vehicle that allows for economic development and financial institutions to serve our businesses. Thank you.
Thank you, Mr. Cavazos. Next, we have Deborah Gorman, who is the President and Chief Executive Officer of the Green Lining Institute.
Thank you for extending this generous invitation to appear at today's hearing. My name is Deborah Gorman. I'm the President and CEO of the Green Lining Institute. Founded in 1993, Green Lining is committed to building a just economy, and we envision a future where communities of color can build wealth, live in healthy places filled with economic opportunity, and are ready to meet the challenges posed by climate change. Green Lining's origins come from the antidote to the discriminatory practice of redlining. While redlining was banned in 1968 with the Fair Housing Act, its effects are still lingering and pernicious. The pandemic, and now inflation, war, rising interest rates, supply chain disruptions, and most importantly, climate change has amplified the awareness, and we now see the significant racial disparities in our economy every day. Going into the crisis, Black and Latinx households had significantly smaller wealth cushions to fall back on than the average American household. To help us achieve economic democracy, we have much more access to data that helps provide more targeted approaches and choice points that can create specific outcomes. We now have sophisticated data science, more predictive analytics, twinning, smart data, GIS, built by computer-based tools used to help us establish different pathways to create prosperity. What this data is consistently showing us, however, is that we actually have two different economies in our nation. That's why when economic shocks happen, all Americans don't experience the impact the same. First, there's the economy of higher income, mostly college-educated white-collar workers, people who can work from home. Second, there's the economy of lower wages, predominantly non-college degree, blue and pink-collar workers. These are the people once employed by restaurant, bars, hotels, salons, gyms, who generally must show up in person, but whose customers are slow to return. When considering pathways forward, we must address how much longer the two economies can continue diverging. First and foremost, there continues to be a need for greater diversity at all levels of financial institutions, service, and products. As noted in previous committee reports, our financial system has created and continues to perpetuate an uneven playing field, contributing to income and wealth disparities. But we cannot address inequity in financial services if we are not prepared to address the future of the entire industry. We must first consider the bank consolidation. 2/3 of bank institutions have disappeared since the 1980s, with a substantial portion of the loss due to mergers and acquisitions, and shifts in the industry towards online financial services, resulting in an ongoing downward trend in the number of consumer-facing bank branches. These consolidated financial institutions must commit to diversifying their management in community benefit agreements, and we need the support of the federal regulations to enforce CBAs and CRA. Green Lining's DIE framework shows that when companies are intentional about inclusive workplace, they help correct income disparities and former broader economic conditions. A singular bright spot, however, is the real progress made in entrepreneurship, which has seen an unprecedented surge since the pandemic. The entrepreneurial spirit is alive across the country, with almost 3/4 of the U.S. counties reporting an increase in the number of businesses. We must make sure entrepreneurs have fair and equal access to various forms of capital. Next, fintech, or non-bank mortgage lending that operates substantially online utilizing technology. We need to ensure all financial services are monitored and regulated to avoid any one sector being the bastion of consumer exploitation. Lastly, we witnessed significant growth in climate finance. We have reached a tipping point where, with regards to climate change and climate finance, We acknowledge that climate change is a threat multiplier for communities who already carry the burdens of disinvestment and low opportunities for improved economic outcomes. Investments to counteract this effect must prioritize these communities first and foremost if we are to tackle climate change head-on. Greenlining, our coalition members, and our community should work with this community and other financial services, including regulators, to assess institutions not just of their willingness to invest in climate-related projects, but in how well it is targeting communities most in need and most at risk. I look forward to answering any questions you may have. Thank you.
Thank you, Ms. Gorman. Next, we have Carolyn Johnson, who is the Chief Executive Officer of Diversity, Inc. And Ms. Johnson, I think we may be having some technical issues with the timer, so I will tap lightly when you're at about 30 seconds so that you can wind down your 5 minutes. Thank you. You may proceed.
Wonderful, thank you. Honorable Chairwoman Waters, Ranking Member McHenry, Chairwoman Beatty, and committee members. For the second time as the CEO of Diversity, Inc., I am honored to testify before you to discuss the importance of accountability and transparency and how it impacts workplace fairness, which is at the center of the work that I have done during my 19 years with Diversity, Inc. Focusing on workplace fairness, our annual survey, which is open now, offers a scientific approach for major U.S. employees and employers with 750 more employees to receive comparative data about the effectiveness of their policies, practices, and procedures in leadership accountability, supplier diversity, human capital metrics, talent development, and philanthropy. 1,800 employers participated and 130 ranked on one of our lists in 2022. In the time I have today, I will share my observations on positive movements made to diversify the financial services sector and the challenges we must continue to address to achieve economic inclusion. But first, please accept my appreciation of the progress the Subcommittee on Diversity and Inclusion has achieved since its inaugural hearing in February 2019, specifically analyzing the racial and gender wealth gap, surveying the state of diversity within the financial services industry, and scrutinizing barriers to economic inclusion for women, people of color, people with disabilities, people who identify as LGBTQ, and justice-involved individuals. I have no doubt that the increase in workforce data transparency we have seen at Diversity, Inc. is due to the tireless efforts of this committee. In 2022, 24% of survey participants self-identified as finance and insurance entities by sharing their North American industry classification code. State Street was one of those organizations and ranked for the first time this year. CEO Ronald O'Hanlon is lauded for saying, "We believe that diverse and inclusive workspaces are critical to achieving superior execution." Those words have merit, as State Street also ranked on the Diversity, Inc. top companies for board of directors, executive diversity councils, and top companies for talent acquisition for women of color. In May of this year, Jose Minaya, CEO of Nuveen, a TIAA company, also on the Diversity Inc. top 50 list, said the SEC's approval of NASDAQ's request to require board diversity disclosures for companies listed on its stock exchange will fuel transparency and accountability regarding practices and reporting on DEI. And this is a start, but there is more work to be done to bring about irreversible, sustainable change. According to the U.S. Bureau of Labor Statistics, the financial management industry employment is expected to grow by 15% by 2029, much faster than the labor market as a whole, and this is due to the increasing demand for financial management services. As the economy grows, skilled professionals who can plan, direct, and coordinate investments will be increasingly in demand. Second, how will that workforce look? According to census data, the United States is now 38.4% people of color and 61.6% white, and women account for 50.8% of the population. Research suggests that by 2045, the United States will be a majority of people of color. While the workforce makeup is changing, some things seem to remain the same. research found that white men managed a stunning 98.7% of the assets in the U.S. investment management sector in 2019. That's hedge funds, mutual funds, real estate funds, and private equity funds. Bottom line, numerous data studies have proven the close relationship between workforce fairness and business success. We must continue to hold each other accountable, and this body must continue the work of requesting data that proves we are making progress and not just saying we are. We must maintain momentum and reinforce what fair treatment is and what decency and values must be. We must not forget that while some have created generational wealth using tools like racism and sexism and classism, fairness and access will always be more profitable. Thank you for this second opportunity to testify before you, and I will be willing to answer any questions you may have.
Thank you, Ms. Johnson. And next we have Mr. Mark Morial, who is President and Chief Executive Officer of the National Urban League. Mr. Morial, you may proceed. Mr. Morial, we can't hear you. Are you muted, or do we still have technical problems? We still cannot hear you, sir.
Can you hear me now?
We can hear you now.
Okay, thank you very much.
Sure.
First of all, let me say to Chair Waters, Subcommittee Chair Beatty, Ranking Member Wagner, and all of the members of the committee, the extreme gratitude and honor that I have to share some observations and thoughts with you today. I must begin by saluting Chair Waters for her lifetime work on closing the racial wealth gap and on understanding the fundamental importance that public policy plays towards that goal. All the way back after the financial crisis, when the Dodd-Frank bill was being considered, it was Chair Waters and members of the Financial Services Committee, Black and Latino members to be specific, who walked out of the Financial Services Committee until the Congress and the Financial Services Committee committed to the offices of minority, women, inclusion, now embedded in many financial regulatory agencies. Indeed, the creation of this very committee placed a further spotlight on the value that public policy plays in closing the racial wealth gap. I want to make a few points, and I would certainly commend my written testimony to you. But here is what is missed in this conversation. One of the most powerful economic development opportunities we have in this country is to close the racial and economic gaps, the wealth gap and the income gap. If we were to do it, it would reflect an additional $2 trillion to the nation's GDP. $2 trillion by closing the wealth gap and unleashing the enormous talent, the ability, the aspirations, and the initiatives of this nation's Black, this nation's brown, this nation's other communities of color, and I would add other marginalized communities to the economic mainstream of this nation. Indeed, if one took the spending power of African Americans and combined it with the spending power of Latinos and Asian Americans, best estimates say that by 2023 or 2024, it would reflect $5 trillion. What does that mean? That $5 trillion means that it reflects a full 1/4 of the nation's overall economic input. It further means that the nation's Black, brown, and Asian American communities, if they were a nation, would be the fourth largest economic, the fourth largest economy in the world, behind the United States, China, and indeed Japan. So this is important to understand the economic imperative and for us to disavow the zero-sum game mentality that many promote, that if one community moves forward, other communities lose out. We must promote economic diversity and inclusion as an overall economic imperative for a nation whose demographics are shifting, for nations whose economic realities are shifting. Indeed, if we do not do it, we won't have the workers. We will not have the growth. We will not remain the economic power that we are. So economic inclusion is critical. Where are we today? Yes, there's been some progress, but much of that progress was first wiped out by the recession of 2008 and 9. And further, the COVID, if you will, pandemic knocked the wind out of many Black and brown and small businesses in this country. So there remains an economic gap. Approximately $40,000 in average income for a Black family, over 70 for a white family. A home ownership rate of 44% for Black families, over 70 for white families. These realities point to where we are. I commend this committee's work. I encourage the leadership of the Congress to maintain this committee for its focus is so important. And I want to again thank Chair Waters and Chair Subcommittee Chair Beatty and the ranking member for holding this hearing and for putting a spotlight on all of the very important work that you all have done. This is only the beginning. Thank you.
Thank you, Mr. Muriel. And next we have Mr. Garcia Diaz. You're now recognized for 5 minutes to give your oral presentation.
Madam Chairwoman, Ranking Member Wagner, and members of the subcommittee, thank you so much for the opportunity to be here to discuss diversity in the financial services industry. My statement today draws from our work since 2017, including our analysis of management-level workforce trends. This work was completed at the request of this subcommittee and the full committee. Almost 4 years ago, at this subcommittee's inaugural hearing, I remarked that management-level representation of minorities and women showed marginal increase from 2007 through 2015. The situation was especially concerning when we looked at representation at the most senior level. Although minority representation at the senior level increased from about 11 to 12% over this period, African Americans were the only group that experienced a slight decrease. Among middle managers, an important pipeline for more senior positions, overall minority representation increased from 19 to 22%. African American representation among middle managers fell slightly as well, while other groups saw some increase. For this hearing, we analyzed the most recent available EEOC data for 2018 through 2020. During this period, minority representation, again at the senior management level, grew to 15% in 2020, and all groups experienced some growth or were relatively stable. For example, the share of senior managers that were African Americans increased slightly to 3% in 2020 and 4% for Hispanics. Asian Americans grew slightly faster than the others. The pattern was similar at the middle management level. Overall minority representation increased to almost 28% in 2020, with notable growth for Asian Americans, reaching almost 11%, and more limited growth for Hispanics, reaching almost 7%. So what are the trends beyond 2020? There are concerns about how the pandemic and current economic conditions, including recent layoffs in banking and mortgage lending, will affect the demographics in the industry. Analysis of future releases of EEOC data will shed light on this issue and may be an area for additional congressional oversight. So what are firms doing to improve these trends? Our past work highlighted some promising practice to address challenges and expand opportunities. For example, our reports on the Federal Home Loan Banks and Fannie Mae and Freddie Mac, done at the request of the subcommittee, generally found that these firms face similar challenges in recruiting, retaining, and promoting women and minorities. But we found that these firms implemented a variety of leading practices to maintain and increase diversity in their workforce. For example, they implemented diversity and inclusion strategic plans, used quantitative data to establish benchmarks and measure progress, and conducted targeted recruitment to build potential pipelines. Let me expand on one of these leading practices, recruitment. Stakeholders have noted that some firms tend to recruit from the same academic programs and institutions, yet relying on the same sources for recruiting and hiring may not be sufficient to enhance diversity. Our interviews with stakeholders point to the importance of recruiting at a broad range of schools, not just the elite schools or where there are existing relationships. One firm noted that recruiting students from a range of academic disciplines and different degree programs also can help expand the pool of candidates. The idea is simple: casting the widest net possible. Recruitment at certain targeted academic programs can be challenging, however. Although our 2017 report showed that the talent pools for the industry, such as undergraduate and MBA programs, generally are diverse, some groups are significantly underrepresented in certain fields. For example, in work we conducted on women in STEM, at the request of the ranking member, we noted that the financial services is increasingly reliant on technology. Yet women are significantly underrepresented in these degree programs. We found that some financial services firms have made efforts to promote interest among women in both STEM and financial services. For example, they provide funding and other supports to nonprofits focused on increasing girls' participation in STEM and offered STEM scholarships. I would like to share one final thought. My March 2021 testimony highlighted the importance of employee data collection and analysis to measure progress of efforts and identification of challenges. Effective use of employee data can help firms meet their full potential in ensuring that opportunities for hiring and advancement are available to all. This concludes my opening remarks today. Thank you again for the opportunity. I'd be glad to answer any questions.
Thank you, Mr. Garcia Diaz. This Congress and I've been glad to spearhead efforts on language access to financial services. I'm grateful to the subcommittee and Chairwoman Beatty and the full committee and Chairwoman Waters for their support on these initiatives. One of my top goals has been to ensure that everyone, regardless of their native language, has equitable access to financial services. Nearly 9% of individuals in this nation speak English little or very little. This means that more than 26 million people have limited English proficiency. It is essential that these individuals are not left behind by our financial system simply because they cannot speak the language. My district is 77% Latino, and I've spent a lot of my time here in Congress and this committee working to make sure that Latinos have access to capital, housing, language options, generational wealth, and equitable financial inclusion. Without objection, I ask unanimous consent to insert into the record a statement for the National Association for Latino Community Asset Builders. It highlights both progress and work still need to be done better for better financial inclusion for Latinos in our country. Without objection, it'll be entered to the record. I'll start with questions. Mr. Cavasso Reyna, I would like to give you some time to respond to a way that we can ensure that Latinos are better included in our nation's financial system and economic success, including both language access and other avenues.
Thank you, Madam Chair. I think that those efforts are critically important. During the pandemic, we worked in tandem with the Small Business Administration to make sure that the programs that were coming out of the economic stimulus packages were being dished out to our community in various languages, not only Spanish, but many other Asian dialects in our community, because these were substantial barriers to access for minority communities to not only be able to access the capital that these government programs forged to better the economy, but also in the way that our minority communities on a daily basis have access and are able to interact with the government. I think that we need to set new precedents in how government approaches minority communities and also how financial institutions are aware of the needs that exist in our communities. I think that there's a huge lack of cultural competency by some of America's largest institutions on how they approach our communities and how they are able to give products to our communities that'll help us evolve and scale our businesses. Our economic vitality really depends on our ability to access these different programs, not only in different languages, but also have different access points of technical assistance. why the codification of the Minority Business Development Agency at the U.S. Department of Commerce was such a historic and critical move by this Congress, in order so that that can serve as a vehicle to small minority-owned businesses in unserved and underserved communities across this country be able to access the technical support that they need to be successful, that they need to continue to provide jobs in the communities where they live and operate, and the need that they give organizations like the U.S. Hispanic Chamber of Commerce to provide those necessary services throughout our network of 260 chambers of commerce.
Ms. Johnston, your organization focuses on business benefits of diversity. Can you please speak about ways to increase diversity in the senior leadership positions of financial institutions and why it is so important for businesses as well as consumers?
Thank you for the question. So speaking to the importance of measurement, because that is what we do at Diversity, Inc., we cannot honestly talk about an issue unless we are sharing data, unless we are analyzing that data, developing a strategy, an action plan, executing, and then checking back in to ensure that the progress we intended to make is actually being made. And it is important because we know that understanding of what your workforce needs, what they want, translates into better understanding the marketplace in which you find yourself. And so we must make sure that there is a connection between workforce fairness, and that translates into fair treatment of consumers, which is why this work is so important and which is why this committee is so important.
Thank you so much. And finally, I wanted to ask Mr. Garcia Diaz, what is the most significant finding that you have discovered in the reviews and studies that you've done at GAO that would address some of our concerns? And regrettably, you have like 1 second because I think I only have 4 left.
Well, I would emphasize the data analysis part, understanding the shape of your workforce, where are the challenges, in order for an organization to address them and create tailored responses to those challenges.
Thank you. That concludes my 5 minutes. I now recognize the gentlewoman from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Madam Chair. Research has shown that one of the most impactful ways to increase inclusion and work in the workplace is through mentoring and networking. Visible engagement of management through sponsorship has proven to boost retention of women and minorities. Mr. Garcia Diaz, what efforts have you seen to increase mentoring and networking through programs like employee resource groups? And what additional efforts can be employed to increase internal and external networking?
And so in the work we did in response to your request, we explored this very question and talked to many firms about what they're doing to promote, in that particular case, representation of women. But I think a lot of the principles we learned there are applicable more broadly across all populations. And so the role of, particularly of developing not only these mentorship relationships and resource groups, is a key part of achieving one of the basic practices we've identified in the past, which is employee involvement and communication among employees. The other part, I would say, is that a lot of efforts, aside from mentoring, include things like creating family-friendly policies and also even creating policies or programs that encourage women to return back to their employer should they take extended leave or decide to start a family, that there's a process to bring them back. And so the thing is that if you take a step back, it's how can an organization create an institutional response to these challenges and actively manage it, be aware of it, going back to my earlier point about understanding your workforce, what the needs are, and designing programs to respond to those challenges and measure progress.
Thank you. This subcommittee held several hearings on the challenges of accessing financial services and products. Millions of Americans remain and underbanked. The FDIC conducts studies on household banking status across the United States, and in its 2019 report, the FDIC found that 5.4% of American households are unbanked. The report also noted that unbanked and underbanked rates were, quote, higher among lower income households, less educated households, younger households, Black and Hispanic households, working age disabled households, and households with volatile income. Mr. Garcia-Diaz, beyond lack of funds to keep in an account, can you discuss any additional reasons for not having a bank account and how we can make progress in this area?
One general concern, and we had past work looking at financial literacy, having folks become aware of the range of products that are available, how they can assist in managing their finances. And so financial literacy is an important bedrock here in making sure that starting from early education and onward, that people are learning on how they can use the financial services system. There's also the side of outreach that the financial services industry can do to reach different populations that may be traditionally underserved.
There have been several private sector initiatives in recent years to collect and disclose diversity data, including those by PwC, Glassdoor, NASDAQ, and Fortune. Mr. Garcia-Diaz, could you talk about how these efforts can begin to move the needle on D&I in a meaningful way by allowing companies to tell their own stories, highlight successes and failures, and account for the different sizes, resources, and geographical locations of businesses across the country?
Yeah, so the sharing of information, both to the broader public, but within the financial services community, is something that we see some larger firms are starting to do. In our work, some have expressed a little bit of concern about disclosing information because, for instance, firms that are trying to improve their diversity might not look as good as they would like to, and so in those situations, it might serve as a deterrent from folks applying and maybe working there. But in the end of the day, more information about the status of diversity efforts is a positive thing and should have a virtuous cycle too.
I thank you, and I yield back.
Gentlewoman yields back. The gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Madam Chair. Ms. Gorman, I was hoping to ask you a question about another impediment to full economic inclusion, which is the paper ceiling. Opportunity at Work, an initiative for full economic inclusion, describes the paper ceiling as an impossible threshold that includes degree screens, biased algorithms, stereotypes, and exclusive professional networking that block career opportunities for workers. In a sense, it is examining with a critical eye a labor marketplace that rewards signaling more than it does skills. And it found that there are 30 million what they call stars, which are workers who are skilled through alternative routes, S-T-A-R, stars. They are skilled through alternative routes instead of having traditional bachelor's degrees. 30 million of stars. They have skills for jobs that pay substantially more than their current role, but they mostly don't transition into higher wage work when they are switching jobs. There's an inefficiency here in the labor marketplace for them. Could you talk a little bit about how job candidates, about stars, and how they might best leverage entry-level or mid-level gateway roles in the financial services sector? How can we do better, in brief, to hire for skills rather than for signaling?
Yes, thank you for the opportunity to provide some solutions. The signaling is also part of cultural competencies within that organization. I think, as you've heard earlier, that the intent comes from setting your goals, collecting data, and then being transparent about it. So by not doing those things, you are in fact signaling that that is not important. So if I am a young person from whichever group and I am joining an organization and there is no sorts of corporate environment that is talking about promoting those who have different skill sets, or those things that are measured through perseverance or addressing adversity, which are very important in the workplace, then of course you will feel that that's not valued. So this paper ceiling makes sense to those who have skills, who are applying it, but the company is not, in fact, verbally or otherwise reporting on it. So I think how you set the goals, how you message, how you account for it, and then what you measure is also a way of somehow breaking through that paper ceiling.
Have you seen specific companies or industries within the financial services sector do anything particularly noteworthy on degree screens or on their resume sorting algorithms? You know, most Fortune 500 companies, when you put your resume into that digital docket, it's not a human being who first looks at it. It's going to be some kind of algorithm that's going to be sorting it, and they're going to be screening for keywords and also screening for a 4-year liberal arts or bachelor's degree. Are you noticing any companies that are making laudatory steps forward in how they think about those screening to screen for skills rather than just for the paper ceiling?
That's right. So it starts with the algorithmic bias that you see. So the coding that's being done has bias for the words in LinkedIn and some of the other platforms have now started to realize that the coding that they use bring in biases that exist. So zip code or education or language. And so now they're starting to, and you don't necessarily have to understand the coding as much as understanding the outcome. So if you're looking for different outcomes, then you can sort of say, here's the outcome we need in order to change the access to the opportunity. So also including different communities, right? And so if you're including HBCUs or you're including community college, as an access, because now that's a cheaper way to getting your 4-year degree, to 2 years in a community college. If you're including some of those metrics, then you will, in fact, create a more diverse pool of candidates to have achievement. So I think they are now really starting to, and the work that we do at Greenlining for the algorithmic bias is that you look at the systems you have, monitor and track and collect it, and then see what biases are in fact producing the outcomes that you don't want, and correct for those biases. So we see that systemically happening, and we do see ways that you can include a diverse population in order to get a different outcome.
I'll reclaim my time in the last 10 seconds just to say that while there may be regulations at the federal level that can induce this behavior, really this should be in the self-interest of industry. We are short of workers right now as a country. Every industry I talk to is desperate for, frankly, all skill levels, and they need to be looking at how they are screening out people at the very first levels here to fill their slots. I'll yield back.
Gentleman's time is up. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
I'd like to thank Ms. Garcia and thank Chair Beatty and Ranking Member Wagner for holding this subcommittee hearing, and also thank you to our witnesses for taking time to be with us and testify today. I'll start off echoing the same concerns that I voiced in our last hearing. In the last 139 days, we have only held one committee hearing at any level with witnesses from the Biden administration. With the majority shielding their friends in this administration from scrutiny, we have completely failed to conduct adequate oversight. I hope that in a few short weeks, when Republicans take over the committee's schedule, that we'll finally go back to holding hearings with government officials and reasserting our constitutional duty to hold these bureaucrats accountable. As I reflect on our time this Congress and on our specific work in this subcommittee, I am a bit disappointed in the direction that the majority has taken. We held 9 subcommittee hearings. Not a single hearing was conducted with a member of the Biden administration. And I don't believe that the majority fought hard enough to get some of the C-suite level witnesses from our nation's largest asset managers or insurance companies. When Larry Fink sent his global head of diversity, equity, and inclusion instead of testifying himself, that should have been taken as an insult by this committee. Now you have BlackRock voting client shares to support racial equity audits and other ESG-related scam proposals put forward by corporate gadflies who abuse our security laws to devalue companies in pursuit of their political agendas. Now, as my time is limited, I will dive into my questions. I wanted to follow up Ms. Garcia-Diaz with Mr. Garcia-Diaz, follow up on a line of questioning from Ms. Wagner. Isn't it true that one of the most commonly cited reasons for not having a bank account in the FDIC surveys are concerns surrounding privacy because financial institutions are required to regularly report information about their customers to the federal government? Mr. Garcia-Diaz?
Yeah, I do. I don't know the answer to that question. I'm sorry.
Okay. If you don't mind, if you might look that up and get back to us, I'd
I would
appreciate it.
I would be happy to follow up.
Thank you. That is the case, but we'll look forward to you giving us that answer. Equity is being embraced wholesale by schools, corporate America, the Biden administration. It has infiltrated hiring, curriculum, admissions, trainings, and more. But equity is not the same thing as equality and delivers very different results. Rather than providing all individuals with equal opportunities to succeed, equity segregates individuals by race. It calls for institutions to treat people unequally in order to achieve equal outcomes. Equity recklessly embraces legally prohibited classifications as a way to eliminate perceived differences in outcome, in violation, I believe, of equal protection and federal law. Mr. Garcia-Diaz, do you believe that it is fair to use equity as an excuse to treat people unequally in order to achieve a desired outcome?
So there's quite a bit of range of definitions that people use for equity, but to answer directly the question, in most situations, whether it's employment or lending decisions, treating individuals differently, disparate treatment of them is a violation, typically regarded as a violation of various laws.
Thank you. Mr. Morrill, would you like to respond to that?
Is the process by which we dismantle a historic system of slavery, segregation, and discriminatory processes and procedures in this country. It is not treating people unequally.
So more
It is
discrimination is the
designed to
answer to past
Sir,
discrimination?
let me finish, sir. Let me finish. Sir,
Well,
let
it's
me
my
finish.
time, sir. Actually,
No,
I
I'm
think
not going to let you.
I think
You're not going to ask me a question and
I think we're going to
insult me
move
by
on.
interrupting
So
me.
thank you.
No, you
So
don't want my
Ms.
answer,
Gorman,
Madam Chair?
how would you
Gentleman,
say?
gentleman is reclaiming his
May I have
time.
an opportunity to answer? May I have an opportunity to answer the question?
The gentleman's time has
called on
expired.
I yield
I
back.
testified
The
before
gentleman's time
Congress.
has expired, and the chair is reclaiming. The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the Task Force on Financial Technology, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman, and I want to thank Ms. Beatty and Ms. Garcia as well for chairing this important hearing. One of the other chairs, as the chairman mentioned, one of the other responsibilities I have is chairing the subcommittee on, the task force on fintech. And one of the claims that the fintech industry repeatedly makes is that it is a mechanism for inclusion. And while I do think the potential is there, we've done a number of investigations on buy now, pay later, and earned wage access and other aspects of how fintech works. and we have found that those claims have not been justified. And I'm wondering if, I know we have several witnesses here that operate in that space, Ms. Johnson and others, and Mr. Morial. I wonder if you could speak to that. What about these claims? Now, I do realize, and I'm hearing from constituents who were caught up in the FTX collapse. They were, I think, sold a bill of goods that was not factual. They thought their investments were protected and they were not. But what about these wider claims of inclusion by the fintech industry? Are those justified or are they not?
Congressman Lynch, I'll take the question. In theory, and to some extent in practice, fintech, the ability to access financial services online, can level the playing field. However, if fintech operates outside of established norms and regulations, fintech has the opportunity to engage sometimes, and I do not want to make a blanket accusation, in practices which can be deceptive, misleading, or in products that are more expensive, have more, if you will, difficult terms for people. So this is really an important, both an opportunity, because it's an innovation in technology. I think the committee and our nation has to place fintech under a regulatory umbrella and not fall into the trap that guardrails are somehow stifling innovation. No, those guardrails ensure that what we just saw happen with Bitcoin or with crypto does not happen, where many innocent Americans suffer potentially huge losses. So let's understand that in theory and to some extent in practice, it can increase access, but it can also be very damaging and injurious if it is not subject to the same set of guardrails that non-fintech is subject to. And it's a subject that I think we have to confront as a nation.
Well, thank you. I know that there are areas of our country where especially in minority communities, where folks are unbanked, where the traditional banks have removed branches and leave people with very few alternatives. On the other hand, I'm also seeing a lot of hype on the part of fintech and especially crypto products that are luring people, I think, to put their hard-earned savings into very speculative products, and they aren't being fully informed. Ms. Gorman, would you want to take a crack at that question as well?
Yeah, absolutely. I was enthusiastically nodding here. As I mentioned earlier with fintech, you have to ask yourself, why is it easier? Because there are lower barriers to entry, which tells you that our current financial system has higher barriers to entry. So the access also makes it attractive. But as I mentioned before, there's real threat of algorithmic bias, that fintech is only as good as the technology and the algorithms that is written. So you're able to have predatory practices if there's not some sort of oversight, some sort of disclosure, some sort of accountability. So while it has lower barriers to access, because I can just pick up my phone and I can be targeted, there's inherent biases that the banking industry holds up and creates those fees, and the tech industry that doesn't.
Gentleman's time has expired.
Does not.
Gentleman's time has expired.
Thank you. I yield back.
The gentlewoman from California, Ms. Waters, who is the chair of the full committee, is now recognized for 5 minutes.
Thank you very much. I'm going to talk about a recent study by the Federal Reserve Bank of St. Louis. The black-white racial wealth gap has seen little improvement over the last 20 years. In fact, in my city of Los Angeles, the black home ownership rate was 34% in 2021, lower than it was in 1910. We know that owning a home is a primary driver of wealth in this country. Any efforts to reduce the racial wealth gap require creating more paths to home ownership for individuals traditionally excluded, as well as addressing ongoing discrimination and bias in the housing market. That is why last year I introduced my Down Payment Toward Equity Act to provide financial assistance to first-time generation homebuyers. I'm also working to finalize my Fair Appraisal and Inequity Reform Act, which would address appraisal bias and discrimination by reforming the federal oversight structure of the industry, streamlining the fair housing complaint system, and making key appraisal data available to the public, among many other important provisions. So first of all, I want to thank Mr. Morrell for being here today, because I know how hard the Urban League works in order to help build home ownership. It's one of the top priorities. But here's what I want to know. Many of our banks, or some of them, they woo us with donations, and they have a banner up at the church banquet, and they give what I consider relatively low contributions to keep the relationship. But Wells Fargo was found to not do home refinancing, which is so important to us during this inflation. What can we do with Wells Fargo, for example, who, rolls out all kind of interesting little things that they are doing in the Black community. But when you look at something like an inability to get them to do refinancing, how do we deal with that? Mr. Morrell.
Yeah, thank you, Chair Waters. Look, I believe that in the environment we face today, we need to also encourage banks to offer to people second mortgages versus refinancing an existing mortgage at a higher interest rate. I think the larger question, and I think it's an important question, is whether refinancings, purchase money mortgages, consumer loans and business loans are going to be available to the Black community and the brown community on a more equitable basis by Wells and all of the other banks. And this committee's continued oversight, continued advocacy is so critical and important. I agree with you, Chair Waters, that we have to find more ways to support people with down payment assistance. We have to reform the credit scoring system, which screens out many African-American potential homeowners. We have to pay close attention to the discriminatory practices amongst AI, artificial intelligence, in automated underwriting. And all of these are things that serve as barriers. So I think continued oversight and pressure by this committee is so essential. And it is my hope that in the new Congress, I know that your voice and the voice of many on the committee will continue, notwithstanding the change in the majority.
Well, I understand Wells Fargo. It's, attempting to work with the Urban League relative to some other issues, but I'm focused on the fact that Wells Fargo rejected 50%, half, its Black applicants in mortgage refinancing. So I bring that up today because I think that you may have an opportunity to say to them that today, when you came to talk about what could be done in helping with home ownership and retention, that this is an issue that they really need to deal with, because I'm going to pay a lot of attention to it.
Yes, and Chair Waters, I want to agree with you that those numbers are unacceptable. Those refinancing numbers are unacceptable.
Thank you so very much, and I yield back.
Chair yields. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairman. And I would really want to extend my appreciation to Chairwoman Waters for convening this subcommittee, but also for Chairwoman Beatty for leading this historic work of our subcommittee. So much has been accomplished in having the really meaningful conversation around diversity inclusion. The committee held a hearing on CRA, the Community Reinvestment Act developments, and whether it would lead to expanded access to financial services for low and moderate income communities and communities of color. And we all know and talk about it and debate it, but CRA has unfortunately become some sort of cover for, I think, some of the struggles and issues of being effective on the ground for communities like mine. And I know CRA proposed joint rule-making comment period recently closed. The Green Lining Institute urged regulators to include racial equity, climate resiliency, and assessment areas in their consideration. And so I'm curious, for you, Ms. Gorman, why are these considerations important? Because I know for advocates and folks as part of my housing work group have said CRA isn't working as it was intended. But so including those three elements, why do you think that's important right now?
Yes, thank you so much for the question. That we really have learned through our assessment that you don't change what you don't measure, and that you don't address the communities that you hope to involve without actually including them. So being proximate and involving those communities will allow you to create the change and will allow you to call in rather than call out the activities through the CRA. We also believe that the leadership within those, to the point of the chair of executive leadership, management leadership within the banking community will also impact CRA. So we believe that by setting those goals, measuring it, and then revisiting to hold accountability allows us to use CRA as one of the actually only leverages we have within the financial institution. And we're also doing CRA at the state level so that we are proximate to communities.
Yeah. For Michigan's 13th congressional district, I don't know if the panelists know this, but more than half of the owner-occupied single-family homes are actually valued less than $100,000. Our state lost more Black home ownership than any other state in the country over the last 2 decades. But this is hardly a problem exclusive, obviously, to urban communities, and I continue to say this. Low-priced homes encompass a large share of the housing stock throughout the Southeast, Texas, and the Great Plains. And so, Ms. Gorman, do you think giving lenders credit on their CRA exams for originating, mortgages under $100,000, either in partnership with MDIs or CDFIs through special purpose credit programs, would that be an effective incentive for banks to make more loans of that size?
Oh, absolutely. The barriers to certain size mortgages creates no incentive for the banking industry to not just even in home loans, but in small businesses. And really, we're asking to look at such things as special purpose credit instruments to also create more access. So lowering the access to and qualifying for CRA, it would be significantly beneficial.
And this is to the other panelists. I mean, we know that, all of us know from just our history, not only from academics telling us this, but owning your home can be an incredibly strong economic foundation for families. I've seen it all throughout Detroit, which is the most beautiful, Blackest city in the country, where having your own home helped elevate people out of poverty. And so to the panelists, how do you see our housing affordability crisis impacting racial and wealth gap in our country? I know I see the specific things that need to happen and how people are working around, again, CRA and all these other things, but, do you have specific policy recommendations for us? I don't know if Mark or...
Yeah, I can offer the following thoughts, and I appreciate your attention to the fact that lower cost housing stock creates an opportunity for people to become homeowners at a lower price point. and thereby rebuild neighborhoods and rebuild equity. It's a great opportunity. So my suggestion would be very quickly, we need more down payment assistance programs. We need a method to address.
The
I think
gentlewoman's time has expired.
credit. And also,
Chairman, I'll follow up with the panelists. I'm so sorry,
Yeah.
Mark and Caroline. And you will follow up with both of you on these policy recommendations. Thank you so much for your time.
The gentlewoman yields. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to all of our witnesses for being here today. Something I've talked about before in this committee, and not just I, of course, all of us have, is that diversity and inclusion is not just the right thing to do, it's also the right thing for the bottom line. An analysis by McKinsey found that firms with higher gender and ethnic cultural diversity were likely to be more profitable than less diverse firms. Ms. Johnson, in your testimony, you quote State Street CEO Ronald O. Hanley, who said, quote, "We believe that diverse and inclusive workplaces are critical to achieving superior execution." You also went on to say that, quote, "Fairness and access will always be more profitable." You touched on this a bit already, but if you don't mind, could you expand on how increasing diversity improves a company's performance and profitability?
Absolutely, and thank you for the question. And so when we think about what we do at Diversity Inc., where we're looking at not just representation, but we're also looking at talent development. And specifically, when I say talent development, I'm referring to programs that allow for individuals to be mentored, individuals to be sponsored, and individuals to have proximate relationships with leaders, so that they will stay at an organization, allow an organization through their skill set to be more competitive. And so when we talk about it's not just the right thing to do, it's the profitable thing to do, I think one of the things that sometimes goes out of people's minds is replacement cost. And according to the American Center for Progress, the direct replacement cost is about 210%. And so that doesn't take into consideration the indirect expenses around loss of productivity, processes that were not properly transferred or documented. And so the time to be able to go back and understand that work, it just really does impact an organization's bottom line and their ability to execute when we are not looking at this topic like we do any other business subject.
Thank you, Ms. Johnson. Mr. Morial or Mr. Cavazos Reyna, do you have anything to add to that? In other ways, how does this increase profitability?
I'll just very quickly say that it is clear to me that those companies that have made the commitment to diversity, equity, and inclusion at their board, their C-suite, and with their personnel, the data is overwhelming. You said it at the top. What is the difference is a company that both has a commitment and a plan, and as several witnesses have said, measures against that plan. Those are the best practices to do this, and I think the evidence is overwhelming that more diverse companies are more profitable.
Thank you. Mr. Cavazos Reyna, do you want to add?
Yes, I will just add that it is critical, and I think that there's another layer to uncover here, that also companies need to make a concerted commitment to also diversify their ability to procure with minority communities and how that transcends to their bottom line. Because if corporate America is making a substantial investment in small minority women-owned businesses across this country, then inevitably they are creating jobs and creating avenues of wealth for this community. So the systemic gaps begin to close. So not only putting people in positions of power in the boardroom or in the C-suite, but people who actually have the power of the pen and can write people checks in order so that they are procuring with minority-owned firms is also a layer to this entire diversity, equity, and inclusion conversation.
Thank you for all of those layers to our testifiers. And of course, it's not just increasing the bottom line for the company itself, but for the subcontractors and companies that they procure with, but of course, most importantly, with the people, the diverse workforce, and how it increases their economic outcomes. In terms of minority businesses, Ms. Gorman, I wanted to jump to you in the just remaining time I have, and I don't have any time. Hold on. How do we best support minority and women entrepreneurs? I have to admit to you, in my 4th Congressional District, we have a tremendous number. So in the 17 seconds I have.
Yes, supporting women-owned businesses really comes with providing access to capital, providing mentorship and leadership for them to connect with, and providing support for both within the community for their products and services that will allow them to sustain their businesses.
I thank you all, and thank you, Mr. Chair. I yield back.
Gentlewoman yields. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to the email address provided to your offices. This hearing is adjourned.